All right, good morning, everyone. We're Team G. My name is James Rosen. This is Emily Dunaway, Wesley Bowman, and Stephen Sadie. Today we'll be talking about Genuine Parts Company. The team and myself are assuming a 3-year investment horizon for this report. And over that time frame, we think the company is going to realize some growth coming from their expanding global network, soaring automotive demand, trends really sort of favoring the aging of vehicles on the road, as well as some impactful synergies from some recent acquisitions. We do see some risks over that time period as well, though, coming from the demand and rising pressure for the electric vehicle market, sort of the closing ecosystem from auto manufacturers, and perhaps, and most importantly, risks coming with the COVID virus. Overall, we think a hold is the best investment stance for that time period.
So now for a quick company snapshot. So as you probably know, GPC engages in 2 main segments. So one is their automotive aftermarket segment, and then the other segment is their industrial segment. Automotive aftermarket is really what you think it would be, just parts for cars after you purchase them, and then industrial is more stuff like pneumatics, hydraulics. They have a lot of leading brands like Napa, Alliance Automotive, and Repco. And so a quick industry overview. So as mentioned earlier, the automotive aftermarket is concerned with parts, replacement parts as such, for after you purchase a car. And then these graphs kind of show a lot of the steady growth of the industry, as well as just an increase in the vehicles in operation. And then so the competitive positioning for GPC. So there are 2 key differentiators that the company has that we really feel sets us apart. So one is their large global distribution network. They've really started to capture a lot of international and national markets, as well as their leading brand names as mentioned earlier. Specifically, there's a $230 billion plus global market opportunity, and GPC is already capturing a lot of that total addressable market, being 8% worldwide. And if you look at different countries, for example, Australasia, they have about 20%, US about 14%, Mexico 1%, and so on.
Moving into Porter's 5 forces, there are really 2 main things that we want to highlight here, and I'm specifically going to be speaking on the 2 areas we find to have the most risk associated with them. The first one being competition within the industry. One of the biggest risks that we see here is with automobile manufacturers beginning to develop and sell their own replacement parts, which is something that GPC is going to have to be really proactive in developing a strategy to ensure that they are differentiating themselves in that area. And then in addition to that, the power of buyers is becoming increasingly more of a risk, especially with the aging fleet of vehicles on the road. We have more entrants entering our market here, and GPC is going to have to be really careful about setting themselves apart in this area, making sure their products are most effective. And we do see some really good ways that they are already beginning to counteract that.
So looking towards the investment summary, 3 key points here. First is going to be global underinvestment. Really, when the global pandemic first hit, the automotive industry as a whole pumped the brakes completely on spending. However, starting really in sort of Q3 2020, demand for trucks and cars were at an all-time high. So that sort of spending vacuum that was formed gave a great opportunity for CapEx and productivity to go through the roof. And so GPC being able to sort of provide maintenance to all these new vehicles moving through the market really allowed them to drive up their top line quite well. Next is going to be aging fleet vehicles. Americans on average spend just under $1,200 in maintenance and repairs on their vehicles each year. And so with the rising age of vehicles, now north of 12 years, again, this is a key catalyst for a aftermarket parts provider like GPC. Finally, key acquisitions. In 2017, the company acquired Alliance Automotive Group, which is a leading distributor of parts in Europe. AAG really brought a deep talent of management and some strong experience across the board, which really is going to help them capitalize on their international expansion in Europe. Next is going to be Motion's acquisition of Cayman Group. Motion is a fully owned subsidiary of GPC, and this is an industrial, hydraulic, electrical, and really corporate infrastructure provider. And this acquisition is really going to allow them to have more pricing power in their industrial segment, as well as allow them to build out their omni-channel e-commerce platform.
So the company historically has had about $1 billion in cash from operations. Over this last quarter, we saw in this last year-over-year, about $1.5 billion came in from pricing power, about 5% increase from automotives, and then also a 2% increase from industrials. And so volume also responded pretty well to that as well. But that money has been used directly in M&A activity. About 37% was used on M&A. About 36% went to dividends as well. Revenues and balance sheet, as far as revenues go, the company, as I said, has had some pricing powers increases, and that has increased industrial about 12.5% year over year, and then automotive is about 10% for an 11% overall increase. Forward-looking multiples, about 12.5 times EV to EBITDA. And then automotive parts, this is a pretty capital-intensive industry, so there's about 4,700 different stores just in Napa alone. But we see an opportunity here in the digital technology investments, especially talking about like do-it-yourself online.
Moving into our SWOT analysis, one of the key strengths that we really see with GPC is just their proven management skills and their defined brand recognition, and I think that goes without saying. But and a weakness that we really did find was the dividend yield, especially considering with the changes in the industry and how there's probably going to be some additional capital expenditures being made in the future, R&D, different things like that. It's going to be really hard, especially with their very high dividend yield. If they were to decrease that to spend more of that money on capital expenditures, like I mentioned before, that would be assigned to investors. That could be an issue, and that's something I think we have to be careful about moving forward. For opportunities, as we mentioned before, we see a lot of opportunities for international expansion. They have proven history of great M&A transactions, and we can see them moving into more foreign markets. A threat with that, though, is being an international company, there are always threats. As we know, there are different political factors going on right now, as well as COVID-19 that are posing some issues in that area.
Yeah, so a few more risks, as Emily just mentioned, the inflated dividend. In Q4, they paid about half of their profits as dividend. They do have strong cash on the balance sheet, but we're worried that if they were to cut that dividend, then there would be a slight decrease to the capital gains for shareholders. Next is going to be acceleration of the electric vehicle market. The EV market is growing about 2 times year over year right now, and these cars require a lot less maintenance, they have a lot less parts. This could be an opportunity if the company does the adequate research and development to respond appropriately, but it's certainly a risk to mention. Next is a closing ecosystem horizon for auto manufacturers. A lot of dealerships are now wanting to sort of capture the entire lifespan of their vehicles. This means they're offering exclusive content or more proprietary products, which could really hurt a third-party dealer such as GPC. Next 3 risks is going to be, again, COVID-19. If the virus hits again, new variant, and there's shutdowns, people aren't driving their cars aren't breaking down, there's not going to be as big of a demand for these parts. And then supply chain risk, especially with everything going on right now in Ukraine and Russia and Europe. This is a consistent risk, and as they want to expand internationally, you're going to be dealing with currency risk, foreign exchange, and political risk as well.
Moving into ESG, a few things that I want to highlight here, specifically under environment. Their renewable energy and conservation efforts have been very notable. They've had a huge reduction in their use and consumption of electricity, water, natural gases, and also they're making great strides in adding in new energy sources that we see are moving in a great direction. One thing I would like to add here, though, is we do have to consider the inflation of these reduction numbers because of COVID-19 impacting business operations. So that is one thing that I considered with how well they are doing. It's also you have to look at their competitors and see that a lot of other people have those trends as well. For social, one of the things I really would like to highlight are their diversity efforts, not only within the company, but something that sets them apart is they really look for supplier diversity, which I find very fascinating, which is it's a very incredible effort that they've been putting into that, and they're very intentional about. And also they're very involved with various community efforts and philanthropy areas. For governance, I also really want to highlight the 85% independent board. It shows a huge diversity of thought. I think that is a great asset and value add and something that they should really be utilizing moving into the future and making these large decisions moving forward. And they also have an ESG task force for the board where they're continually looking at these issues and showing that they are going to improve. I will add overall, though, they do stand at a midpoint amongst their competitors in this area. Even though they are doing great things, making great strides, ESG has been a hot button topic over the last few years, and a lot of their competitors are keeping up with them in this area.
1 minute remaining.
Just one thing to note about this, we've already talked about revenue and key multiples. So taxes have been historically about 25%. It's stayed that way over the last couple of years, and we continue to think it'll stay about that way. And then risk-free rates, when we did our model was 1.8%, but as you know today it's open about 1.97, 1.98. So that's something that could change as well in the future. And now we'll open up to Q&A.
Thank you, judges. You may now start asking questions.
So what methods did you use to value this stock?
We use the DCF and also comps.
Oh, so you use two methods.
Public comps and the DCF.
Could you unpack the DCF a little bit for me? What were your assumptions there?
Yeah. We go back to the valuation. So here's our WACC assumptions right here on the right. Risk-free rate about 1.8%, like I talked about earlier. That's changed to about 1.97%. We have a 4.2% market risk premium that was just taken by FX and other comparables in the industry. And then as far as revenue assumptions go, we assumed about an 8% growth rate. Equity research suggested closer to about 10%, but we were a little bit more hesitant, just given some of the risks that we outlined.
What's that beta?
Sorry, what's that?
Where'd you get that beta?
The beta we took from FactSet as well.
How long a period does that cover?
I believe that was a 5-year period.
I have a question about the growth rate. You just said that you were anticipating an 8% revenue growth rate.
Yes, ma'am.
How much of that will come from organic growth, do you think? How much of that is coming from acquisitions, and how much of that is coming from pricing?
Sure. I think as we talked about earlier, just seeing the price increases, there's been 5% increase from automotives, 2% from industrial over the last year. I think that the most will be inorganic growth just from key acquisitions. As we talked about, they're spending about 37% right now on M&A activity, so we expect future growth to be primarily from inorganic growth, especially in these kind of brick and mortar stores. But we do see some other opportunities for organic growth, just in this do-it-yourself e-commerce model.
What do you think the sort of the organic growth rate for the business is?
I'm sorry, can you say that last part?
What is the underlying organic growth rate of this business?
We factored in about 6% organic growth.
Thank you.
How did you factor the last 2 years into your model? Did you normalize them? Did you put the actual numbers in? How did that impact your model and your valuation?
Yeah, I think COVID's been very difficult just because of halted things, and of course there's been a huge increase when you start looking from 2019 numbers to 2021. So we try to actually go back to prehistoric COVID levels just to look at what growth rates were and kind of normalize looking at that moving forward.
And then, can you tell me a little bit more about the industrial segment, kind of end markets, growth, who the competitors are?
Yeah, I mean, when it comes to the industrial segment, you figure any sort of leading distributor towards corporate companies for their infrastructure. And right now they are focusing on building that much quicker than trying to build it out to have a more even split between their automotive and industrial. As I mentioned, that Cayman acquisition was a competitor and is now going to add some e-commerce and sort of some more pricing power in the space. But when it comes to competitors, you just figure anyone sort of providing large, expensive hydraulic, electrical equipment to corporate companies in order to bolster their end-line products.
Thank you.
Can we go back to the beginning and tell us a little bit more about
Which slide?
right, the very beginning, the stock price chart. So your target price is?
It's about $150.
Your target price is $150, so that's how much upside from now? And I'm sorry, I missed the connection between, you had your $150 stock price and we talked about your DCF analysis. So did you say your target price was based solely on the DCF analysis? I'm having trouble
primarily.
making that connection.
Yeah, the DCF makes up about 80% of that valuation. And then about 20% we use public comps.
So you used 80, so it was that is a weighted average
Correct.
target price?
Yes.
20% comps, 80%?
Yes, ma'am.
Okay. And that's how much
And that's
upside?
over a 3-year horizon too.
When
we
you
see
did that
price chart.
analysis, how much upside was that?
About 25%.
But you have a hold on the stock?
We do, because that's a 3-year period that we see that price target.
Oh, I see. Okay.
Yes, ma'am.
Could you unpack your guideline public company method a little bit, even though you didn't put a lot of weight on it?
You get public comps. Yeah.
So essentially, just kind of with comps, typical looking at metrics for competitors such as W. Grainger, AutoZone Events, Auto Parts. We just go in, compare things, multiples, P ratios, stuff like that, and then kind of see where the industry is, see where GPC was, and then make conclusions from that.
And your conclusion was that?
Relatively to the public comps, I think, financially speaking, ratios look good for GPC. I think one thing also that we factored in was the qualitative aspect of it too. And I think kind of going back to those two key differentiators, the fact that they have that large global network, and with acquisitions, they're getting those leading brands and diversifying the services they offer. I think that really sets GPC apart.
So is there any prospect for multiple expansion for this company?
I'll talk about that just a little bit. They were trading when we first did the model about 14 times. Right before, I think it was about $132, but it's obviously dropped down closer to, I think, $123 today, which is close to about 12.5 times multiple. We think that it's going to be closer to about the 12.5, 13 times multiple. The main thing is from increasing margins moving forward, so yes.
Judges, do we have any more questions? If there are no more questions, that concludes our presentation. Thank you very much.
Thank you all for your time.